Hello, everyone. My name is Keeley Simpson. I'm here today to present to you the Savvy Women Investors Webinar Part 1 series for this week. And today we are starting with Investing and Financial Planning 101. Again, my name is Keeley Simpson. I'm a portfolio manager and senior wealth advisor for BMO Nesbitt Burns. I have been with BMO Nesbitt Burns now for a very long time, for 15 years. I've seen lots of market volatility over that time frame, and what we are experiencing right now in the markets is quite something from a historical perspective. So I will be touching upon some of the market conditions that we're seeing right now as well. And I'll just actually scroll through just to give you guys a little bit of background and also show you guys the agenda in just a minute here. So let me just see if this works. I haven't tried this. Okay, there we go. So money is genderless, but investing for women is different. And so today I'm here to present to you this presentation that I started presenting 15 years ago to the McGill, to McGill Women Alumni in Montreal. And I started with this presentation because actually from a very personal story, my mom was quite sick out of nowhere many years ago, and she needed some brain surgeries. And basically, she was a business owner that didn't really get a lot of advice from her advisor. And so I kind of saw that as an opportunity that I really didn't want other women or other business owners to experience sort of the same thing that my mom experienced and our family went through. So that's why I've started this educational series for women. So hopefully you can have a couple of good takeaways from today, some aha moments. And if you have any questions, I just encourage you to ask them through the chat, and I'll try to get to them as I can throughout the presentation. Just a little bit of background about myself. I'm based in Toronto, Ontario. I have 4 kids. My oldest is 4.5, and my youngest is 4 months old. And we also have 2 dogs, so it's a very busy household around here. And again, I've been with BMO Nesbitt Burns now for 15 years, so I've seen a lot of interesting things over the years. So let's go ahead and start running through the presentation. Just a little note about financial planning is that planning is bringing the future into the present so that you can do something about it now. So just keeping that in mind that, if you want to plan for something in the future, it's important to start thinking about that now and today. And that's why you're all here today to take some notes and start planning for your future. So I'm going to start with a quiz. I'm going to just touch upon why investing for women can be different. I'm going to talk about some of the unique challenges that women face planning for retirement. That's going to be a very brief overview, just because today's webinar, is about financial planning and general investing 101. I will guide you through some basic steps to building your net worth, because I do think that that's important from a financial planning perspective. I'll just talk to you a little bit about when you get to the point of selecting an advisor, what to look for. And I have some resources that will be sent out to you after the presentation today. There's a wealth planning facts and figures, an expense summary, a checklist, and some financial resolutions for 2022. So just to ask yourself a couple of questions. So currently right now, what kind of goals do you have for yourself financially speaking? And what is it that you're doing about them to reach those goals? So right now on a monthly basis, how much of your monthly paycheck goes towards savings and how much goes towards like your living expenses? And how much of the monthly expenses do you think that you could be saving more of? And that's a really interesting question right now, just because of how high inflation has come and how we're seeing that as consumers now, we're being very much impacted on a monthly basis, right? As to how much we're spending to fill up our gas tanks, how much we're spending at the grocery store. So now more than ever, it's really important to have a budget and also to make sure that you're spending money in the right places. So let's just keep going through this. So just a couple of facts, some interesting statistics about women. So apparently 78% of high net worth women work with an advisor, but 1/3 of that 78% don't enjoy investing because they don't speak to their life goals. So women, it's very important for us to be connected to our goals and to be connected to our plan to make sure that we're feeling good about everything. Women have been socially conditioned to believe that finance or money is not really an area of competence, but I don't believe that. Women know way more than we give ourselves credit for. How women relate to money is different than men. We do tend to be more emotional and concerned about life choices. You know, am I going to be a bag lady when I'm older? Whereas men tend to be more about, you know, they just want to know what the big, you know, pile is. Women seek to feel secure, connected, and fulfilled when it comes to their finances. So that's just a couple of interesting statistics when it comes to women. In terms of the unique challenges that women face planning for retirement versus men, is that it's typically presented as a couple experience, and that's not necessarily how it ends up being when you do get to retirement. Sometimes there's divorce, some women are widowed, and some women remain single. Typically, if you take time out of the workforce to care for young children, if you're the person responsible for that, then typically you would build up a smaller nest egg compared to, the male counterpart or to the person who is the primary caretaker for the children. Women are living longer than men. That's always been a fact, but we're living even longer now. In terms of the confidence in investing, again, speaking to that other slide, it's that confidence piece and feeling confident in what you're doing. Some of the non-financial aspects of retirement are that women come out ahead, and we tend to see that men and women complement each other in the retirement planning phase. And over here, this is the retirement expense worksheet. This is a worksheet that is fillable that we're going to be sharing after the presentation is done today. So it will allow you to put a budget in place, which I think will be really handy. And then just a couple of other sort of notes about what sort of retirement impacts we're seeing today with retirement planning is, again, living longer. It's no longer a set point in time. We have that sandwich generation, so caring for young children at the same time as caring for aging parents or grandparents. We're seeing the trend has been this way for many years now, declining pension, and how a lot of people now are retiring with debt, whereas many years ago that was just not the case. Some of the traditional rules of thumb that we've seen over the years when it comes to planning are, I am fine, I have a company pension plan, which may or may not be, true. Sometimes you may need to build up some extra savings to compensate for what that pension plan will be providing you with. One of the common statistics is that you need to save 70 to 80% of your pre-retirement income. Which, it can be true. I've heard that I need to save $1 million, which, could also be true. And then I will be fine if I only withdraw 4 or 5% a year from my savings once I retire. That's a very interesting rule of thumb that has worked for many, many years. The challenge this year, and probably for the next couple of years, is that inflation is much higher. So you may need to withdraw more than 4 or 5%. Markets are very volatile, so the portfolio values are declining instead of increasing. So it's a very challenging time to be managing sort of that withdrawal from your savings perspective. But I don't think many of you in the presentation today are, approaching retirement, since today's is just sort of a general investing and financial planning webinar. I'm just putting this in here for you so that you can just sort of think ahead and down the road when you do get closer to retirement, if that, depending on what's going on with inflation, is just something important to think about. So again, just to wrap this up with regards to how things, how planning can be different for women. So women are taking care of their parents, same time as their children. Women may leave the workforce for a longer period of time to take care of their children. And that was actually a very common theme that we saw when the pandemic happened. A lot of women had to leave the workforce because there was no childcare options for their children. So that's a trend that we have seen over the past couple of years, which will hopefully, work itself out in the near future. Then there's adult children that are returning home after going to school. Caring for grandchildren so that parents can work is another theme that we're seeing. Again, outliving your spouse, divorce, and then working longer if you need to work longer, how much longer and in what capacity. So those are some of the, common themes that we've seen with regards to how women are impacted differently than men. And now we're going to walk through some of the basic steps to building your net worth. I'm just going to pause to see if there were any questions that I missed in the chat. Don't see any that I've missed, so I think we're okay. I'm trying to click into it and it's okay. Hang on. Okay, no questions. Great. I guess there was one question, which was, what did I mean by women come out ahead? So that's a statistic that it's with regards to the emotional well-being of women during retirement versus men. Men tend to identify themselves a lot more with their current work that they're doing, whereas women during retirement, they're focused more on the interpersonal relationships that they've built over the years, and they don't self-identify with the, the day-to-day work that they're doing as much as men do. So it's just a common theme that we've seen with women coming out ahead from an emotional perspective when retirement sort of starts. And that is because men tend to self-identify with the work that they're doing. So when they do retire, they sort of find themselves not knowing what to do with their day-to-day activities until they sort of get a groove of things. Okay, so the basic steps to building your net worth. So the first step is that you want to have a plan. You want to set your objectives. You want to develop a retirement plan for the future because most of the time, one of the primary reasons that we save is so that we can retire one day. Doesn't matter if you're only 20 years old. Getting into the habit of just even putting $25 away every paycheck, it's a great habit to start. You want to create and manage your investment program. So where are you putting those savings that you're getting every week or every 2 weeks or every month? Like, what are you doing with them, right? And then, what kind of advisors are available right now to you? My computer's a little bit slow. I apologize. So the first step is you want to create a balance sheet. So how much are you spending and how much is left over? And it's really important to have a budget again. So the fillable expense summary that we're going to be sending out allows you to put in, how much you're spending on rent or mortgage, taxes, all of that information in one place will allow you to basically create a balance sheet. So how much you're spending on, living expenses versus, how much would be left over, if any. The next step is to create a statement of net worth. So you want to put down on paper, what are the assets that you own minus your liabilities, which is what you owe. So an asset would be a house or a condo or like a cottage, any sort of fixed asset, any financial investments that you have. So any funds in your bank accounts or in your investment accounts, if you have any. And then you put basically down the net is sort of like your net worth, your net number. So you maybe want to just write that down and just get a check-in for yourself as to where you're at today. And, where do you want to go with that? And then you want to pay yourself first. So how much can you save? But also another question would be, how much should you save to reach your goal? So if you're getting closer to actually retiring from your employment, then obviously it would be more important to focus on how much needs to be saved to reach that goal, right? But, I think getting into the habit of it when you're starting out is really important too. So again, if you can, take $25 or $50 every paycheck, like whatever that number is, and start investing it in an account, I think is a great way to get started. So paying yourself first, again, budget. So the expense worksheet, which we're going to be sending that out. An emergency fund is really important if you were not able to find employment quickly, depending on the kind of job you have. You maybe want to have 3 months of net income available in an emergency fund in case something were to happen. I realize that sounds like a very large number, and it's hard to be saving for an emergency fund and then for your retirement and all that. So just want to make sure that you're balancing everything out. One of the questions that's coming in right now is, what should the ideal number be based on your income from a percentage basis? So there's no research studies on this, but I've always believed that saving 10% of your net income, if you can, would be ideal. There's no studies on this, but that's the amount that I save, that I try to save on my employee share ownership plan and my group RRSP plan. That all comes out to, I think, about 10%. And so that's, I think, a good aim if you can make it work. That's, I think, the number that would be good. In terms of knowing how much money would be enough to retire on, that comes back to your budget. So how much do you need to live off of? So if you need $50,000 a year to live off of, and you have, 35 years that you're going to be, living, then you're going to have to sort of like work backwards on that. And there are some great tools and programs that let you plug all of that in to see, what would be a good working number. I think even on BMO's website, there's a couple of calculators that you can use, like retirement calculators, that would allow you to see, how much you would need to have in order to retire. So we have an emergency fund that we need to save into, the retirement savings plan, the tax-free savings account, and then within those accounts, you want to have a reinvestment program. So I'm just going to keep going here. So you want to set your objectives. So my presentation is just moving a little slowly. Okay, so some of the goals that you may have that you may want to save for are like a major purchase. Maybe you want to save for your first house or your condo. Maybe it's retirement, which is what we just touched upon here. Children's education, if you have kids that may want to go to school one day. If you're older, then maybe estate planning is a goal for you. Maybe there's proceeds of insurance that would be another goal. And then gift planning, which would be, like a charitable giving strategy. And then there's just a couple of questions that are coming in, which is, what is a reinvestment plan? It just means that if you're putting money into an account, you don't want it to just sit there. So you want to make sure that you're investing in something, whether it's a mutual fund, an exchange traded fund, more of the stocks that you have in your portfolio. And then the other piece of it is, if you have stocks that you have in an investment account, you want to make sure that you have what's called a dividend reinvestment plan on there, so that the money is not just coming into the account and sitting there, it's buying more stocks more shares. So I'll just keep moving through here. We're getting some questions about sort of like some portfolio questions, which I'll be touching upon towards the end. So I'll save those for after. So you want to know what your 3 sources of retirement income are going to be. So generally speaking, it would be government plans. So if you're in Quebec, it's the Quebec pension plan. If you're in any of the other provinces, it's the Canada pension plan. Which is something that you're paying into off of your paychecks every time. Then there's also the old age security, depending on what your retirement income is, that can be clawed back. If you reach a certain annual income, then the government will not pay you that old age security. So that's just something to think about for the future. And personal savings, which would be an RRSP or a tax-free savings account or any other sort of investment accounts. So, and in terms of replacing today's income, so I did use 5% inflation rate because that's basically, what we're seeing today. So if your income today was $80,000, then 10 years later would be 130. 20 years later would be 212,000. So this is just to sort of show that, inflation is important to, factor into your planning. And one of the questions was, how do you make yourself, inflation proof, right? And that's about setting yourself up and your portfolio for companies that are a hedge against inflation, making sure that you have the right mix in your portfolio so that you can continue growing your portfolio at a higher rate than inflation. That's how you would be able to protect yourself against inflation. The advantages of an RSP are that they are tax deductible and you get tax deferred compounding, very similar to a tax-free savings account. Tax-free savings accounts grow tax-free. So one of the questions was about an emergency fund, like what should you be doing with it so that it's not just sitting there? So you want to be conservative with it because again, it's more of a shorter time, like a shorter term or a shorter time horizon than, your retirement savings or anything like that. I think you want to be conservative with it and buy some conservative, maybe exchange traded funds or maybe a conservative mutual fund so that it's earning something, but it's not, 100% invested in stocks, just because obviously the markets have been quite volatile. So if you needed to have that money because of an emergency and then the money has, gone down because the markets have gone down, then that's not great either. But you could transfer the money into a tax-free savings account and from there maybe buy just like a really conservative, ETF that is more, money market oriented, or maybe you could buy a GIC with it because GICs now are actually paying a much higher rate than they were before. It's just that you don't really want to, take that money and invest it 100% in the stock market because that money could go down. So if you don't have a long time horizon, then, then you're sort of going to be stuck between a rock and a hard place if you need the money because of an emergency. But I understand you don't want to let it just sit there either. So maybe a GIC would be a good option, or just like a really conservative mutual fund or exchange traded fund, that kind of stuff. I'm getting some questions about obviously the sustainable portfolio. I mean, yes, there are some great options when it comes to, sustainable investing. If you guys would want, I can send out some information on that as well. What is sustainable investing? But today's presentation is more of like a general investment presentation. So I didn't get into too much detail about that today, but I'll just run through the presentation for you and we can see where we're at to talk about sustainable investing next. So some of the rules to live by are, make sure that you have opened, an RRSP account. Make sure that you're contributing your maximum if it makes sense. Make sure that you contribute early on in the year or on a monthly basis to get the hang of it, and then investing wisely. So I have a slide on the 2% difference. This year, obviously, the markets are down quite a bit. There's been nowhere to hide. I have the benchmark returns, which I will share with you. And, it's important to be, if you can, to average down on your investments when you can right now, because the markets are down. And at some point, things will turn and it will have made sense for you to be averaging in, during the market downturn, if it makes sense for your monthly savings and for your portfolio. So obviously, if you had a portfolio that had a 6% rate of return, and you had put in $5,000 a year, so a 6% rate of return would be $29,877. But a 10% rate of return would be $33,575. If we just skip forward to year 25, it would be $290,000 versus $540,000. So investing wisely does make a difference, and I think that is just really important to be able to sort of visualize that it's important to be making the right investment decisions for your portfolio. One of the other questions that I'm sort of getting is, is now a good time to buy S&P 500 stocks, ETFs, given the market is down? I do think it makes sense to start adding a little bit of, if you've got cash, then to start adding that into your portfolio right now, because the markets are down quite a bit. We're going to talk about that in a few minutes. I also think that the markets could go down further from where we're at right now. So, if you had some cash, then maybe taking 50% of that cash and adding it in right now would make sense. But I wouldn't necessarily put all of the funds to work right this moment, just because we are in a very volatile time in the market. So it's important to it's just really important to make sure that you're easing your way in and that you're finding a balance with things. This is just information about the tax-free savings account that was created by the government back in 2008. So if you've never opened one, you could contribute $81,500 today if you were 18 at that time. Some of the rules are, don't over contribute, and then just don't contribute, withdraw, and then contribute again in the same year, just because some penalties could be incurred. And then this was just a slide on the tax-free savings account versus the RRSP. So it's a scenario 1 versus 2 versus 3, which is basically just showing you sort of the power of the tax-free savings account, as an investment tool or a place where you can invest, because the money grows tax-free, right? But you can also take it out tax-free too. So if you needed money, then, and yes, the tax-free savings account does cause a lot of problems for US persons. And so if really the tax-free savings account is meant for Canadian residents and Canadian citizens, I wouldn't, if you're going back and forth from the US or you've been in the US, I would consult your accountant before investing, in a tax-free savings account. I will touch upon the bonds being 100% guaranteed. They are not, but I'll touch upon that in a few minutes. So how long will $250,000 last? So rate of return of 6% a year, which was an average rate of return before all of this started this year, with inflation being such a concern. So if you were withdrawing $18,000 a year at the beginning of the year, then it would last for 18 years. But if you waited to retire for 2 years, then it would last 23 years. So I just think it's really important to have a plan in place and make sure that, you're following a plan, to make sure that, you know how much you're going to be withdrawing, how much you're going to need, when you do actually go to retire, so that you're not sort of surprised at anything. And, want to make sure that you're sort of planning every step of the way. And it's important to start planning, even if you've just graduated from university, because, it's proof is in the pudding, or practice makes perfect, and it's a good habit to have. Your needs and objectives is another sort of area that, we want to talk about. So the current financial picture that you may have, which is of course unique to everyone, what your risk tolerance would be. So how much you're willing to, how much of this portfolio value swings are you willing to accept for longer term returns? What your time horizon is. So is it 5 years, 10 years plus, or is it like a shorter time horizon? That will determine what you should be investing in. What your knowledge is, what your time commitment to investing is, and what your goals are. So this is really just information about investing, right? So the investment menu is very straightforward here. So you have short term, which is anything that matures within a year or less. You have fixed income, which is basically primarily made up of bonds or preferred shares or convertible debentures, which is debt that could convert into equity, but is still considered fixed income. Common equity, which is stocks. This year, I guess that's where I should have put my benchmark information. It would have been a good place, but we'll talk about the returns in a minute for this year. So treasury bills tend to be risk-free. They're issued by the government of Canada and some provinces. They don't obviously pay a very high rate of return. And then GICs are very low risk. They pay you interest, and there are terms between 1 to 5 years. Right now, GICs are actually a great deal. If you were to buy a short-term GIC, obviously rates are going up higher, so I would probably stay on the sort of lower end of the maturity spectrum, but you can get a guaranteed rate of return of 3 or 4%, which is less than inflation. So you're not going to be beating inflation, but it's also better than how the markets are performing. So, it's not a terrible option right now. Whereas a couple of years ago, it was basically 0% for a GIC. So, it's better than it was, but then the markets obviously were paying a much higher return. Just calculating your real rate of return. So it's whatever your rate of return would be on your portfolio. So if it was 10% minus inflation at 5 or 6, might be even higher now, would be your real rate of return minus whatever taxes you're paying on your portfolio. That's really to do with your non-registered investments, not your RRSPs or your tax-free savings account. That would equal your after-tax rate of return. And we have government bonds and corporate bonds. Government bonds mostly are straight bonds. They pay you a coupon twice a year, and that coupon is will fluctuate depending on the maturity of the bond. And then you have corporate bonds that will pay the same, so they'll pay you a coupon twice a year. So if it's a December bond, then it would pay you in June and in December the annual coupon rate. And it's important to note that bonds are bought and sold at $100 a piece. So if you have invested in bonds and you're looking at the bond values and you see that they're down, then it's important to know that if you hold those bonds until maturity, you will get $100 per piece when it matures. The challenge, of course, is if we see any credit issues. So if you have corporate bonds and one of the corporations that you've bought into with their bonds, they end up not making it, or something happens with their credit, or their credit becomes more concerning, then you may see a further decrease in the bond values, and you may get, not get $100 per piece on it. That's why government bonds tend to be much safer, or provincial bonds. So that's sort of, when it comes to bonds, because interest rates are going up right now, bond prices have seen quite a lot of pressure on them. So the overall bond market this year, as of the end of June, was down almost 13%. And so we've actually not seen that in it's just not really heard of to have the bond market be performing as negatively as it has, along with the stock markets performing very negatively. It's impacted basically everyone's portfolio more than just seeing market downturns and seeing, the stocks go down, but then the bonds are holding it up. And again, that has to do with inflation being as high as it is right now, and the banks, the central bank and Fed, they basically are saying that they need to raise interest rates to a point where it's going to break the prices for inflation. And so that's what we're seeing right now is a higher than anticipated increase in interest rates that markets were not pricing in. And that's why everything is, acting as it is right now. In terms of interest rates going up, like why aren't we seeing higher interest rates for savings accounts? I mean, those are the banks. I can't really comment too much on that. I think some other, like I think Tangerine offers a higher savings rate for your for a savings account. But again, GIC rates right now are actually a lot better than they were. So you can get, a better deal right now with GIC rates than you did many years ago. Preferred shares are another type of fixed income vehicle that pay regular dividends. They have a credit rating, and the prices should be less volatile historically. But again, because interest rates are going up, we've seen some pressure with price volatility with preferred shares as well. So that's sort of the fixed income basket. When it comes to common stocks, it comes with ownership. They pay dividends, or most pay dividends, some don't. And you can get a dividend tax credit if you invest in them in a non-registered account. And then there's, capital appreciation potential. Obviously, we're not seeing that right now in the markets, but just historically, that's what we're talking about here. Asset mix is a key factor in your decision-making process. You want to know how much you're going to have invested in, stocks versus bonds versus cash. And that should be based off of your risk tolerance. So how much fluctuations in your portfolio values are you, willing to handle for longer term returns? So it's important because it's a strong influence on the risk-reward trade-off. And it's the most, effective method of accommodating, unique investment preferences. So diversification should reduce risk. So if you have like 30 or 40 companies that you've invested in, then it should reduce the risk. And diversification is by asset type, so bonds versus stocks, by industry. So obviously technology has not done well at all this year. But utilities have done a little bit better. Financials is another industry, materials, energy is obviously one industry that's done really well this year. And then by countries, so US versus Canadian versus international. And then I think one of the other questions I saw before, I'm just trying to scroll back up. Oops, hang on. Is maybe that person can just ask it again, just because the chat has it's disappeared on me. But I think one of the question was how much to invest in US versus Canada. And I think it's just really important to have a balance between the two. The US stock market has gone up like the US dollar, compared to the US, how the US markets have performed. If you've had US dollars in your portfolio, your performance this year, because the US dollar has appreciated against the Canadian dollar, would sort of be not protected, but it's not down nearly as much as what the markets are down. So it's just really important to have a balance between everything. So between US, Canadian, by industry, and by asset class, between stocks and bonds, right? a TFSA causes a lot of problems for US expats. Is there another similar account that can be used? No, it would have to be a non-registered account, unfortunately. So the US and Canadian stock markets, this is the 5-year graph. I did not include the most recent downturn just because I didn't think it was nice to look at. So this is 5 years as of the end of 2021. This is to show that, you know, periods of volatility can happen. Things can go down by 30% and then come back up again. And historically, the markets usually come back up. I get a lot of questions about when is the right time to invest. You know, the risks of market timing obviously is that you can miss upswings. And if you're investing in a non-registered account, you can have taxable, you know, capital gains. So you may pay taxes on some of the, you know, moves that you're making. But again, I mean, the markets could go down more from where they are today. So, you know, you sort of have to balance it out. And if you had cash laying around, then I would probably start, you know, adding some to the portfolio now that things are down as much as they're down. I think you want to buy value, you want to buy dividend paying companies because you want to get paid while you wait. When the markets are down, when companies are down, at least you're still getting that dividend income in, but you know, as long as they don't cut their dividends. And you want to take a long-term perspective. So obviously what's happening right now in the markets makes everybody uneasy. And, you know, what we're seeing right now is a lot of market volatility. So I've just included these benchmark returns for you so that you can see, you know, how negative things really are right now. So the Canadian bond universe is down, you know, 12.23%, but long bonds are down 22%. The S&P TSX, so that's the Canadian market, is down almost 10% this year, and that's, you know, as of the end of June. The S&P 500 in US dollars is down 20%, so that's the S&P 500. The NASDAQ, which is the technology weighting, more weighted US stock index, is down 30%. And, you know, I can keep going, but basically we're seeing double-digit negative returns in most categories right now. So things are looking a little bleak, and that's because, you know, the market is pricing in a mild recession. And it's because interest rates have gone up very quickly that the market is trying to find its price. So there's PDF that I could share with everybody, or you could email me if you want to read it or if you wanted to talk about it. But it's our newest publication about equity and fixed income strategies right now. And it's, you know, the title is "A Recession is Not Yet a Foregone Conclusion." So it's, you know, it shows a 45% chance of a US recession right now. But a lot of strategists say that the US is already in a recession. And Canada is very much like, we basically mirror what's happening in the US when it comes to the economics of things. So I think things will continue to be volatile until, you know, interest rates have, you know, increased enough that they've seen a price, that they see inflation decelerating. And so that could be happening for a variety of reasons. But I just think it's important to take a long-term perspective, you know that the markets could go down further from where they are right now. But historically speaking, once you get to double-digit negative returns, you know, things start to, you know, usually climb back up a little bit. And we might see things go up and then go down a bit more, go up and go down a bit more until we really reach that bottoming. And then you'll see the next leg up in the markets. So selecting an advisor. So there are different advisors that you can work with. I just thought I would give you some information on that, you know, before we wrap up today, so that you know what different advisors offer. So generally, if you were going to work with an advisor, you'd probably want to have an interview with them and ask them some questions. Generally, you would want to look in your internal network. So ask family members or friends, you know, who they're working with, who they're happy with, who they're hearing from right now is a really important question. I'm having 5 to 6 client conversations a day right now on my team. I work with my business partner as well. And we have 2 assistants, so we're a team of 4. And I can tell you that it's very busy. We're being very proactive with our client conversations. So it's just really important to be working with someone who is not hiding from what's happening in the markets right now, but in front of you and being active and telling you what's going on and making recommendations for you to act upon if, you know, they don't have a discretionary platform. You want to know what the, you know, expectations are from that person. And then you want to know, obviously, what the costs are going to be, you know, fees versus commissions. I'm not sure what the difference is between a financial advisor and a financial consultant. I've not heard of a financial consultant before. I would imagine that it's, you know, a licensing issue. I'm not sure if a financial consultant would be able to help you actually buy stocks and bonds, whereas someone who is an advisor would be able to help you actually buy the stocks and bonds, if that makes sense. You know, services provided by your advisor would be financial planning, setting goals and objectives, investment research and advice, asset management, progress reports, financial updates and portfolio reviews, and service expectations. So how many times are you guys going to talk every year? And, you know, what kind of information is going to be available when the markets are down, you know, as much as they're down right now? Does everybody absolutely need an advisor? Can one plan on their own? I mean, that's up to you. If you feel like you can handle it, then, you know, and you're doing the research and you're doing the buys and sells yourself on an online platform and you're using a financial planning software, then yes, you can do it on your own for sure, as long as you feel comfortable in the knowledge that you have to be able to sort of guide you through, you know, like what we're seeing right now with the markets is it's a challenging time for sure to be investing. So I think you just want to make sure that you're making, you know, the right decisions. A lot of our clients right now are relying on us to provide them with the real information and not all of the noise that we're hearing in the news. And, you know, the media tends to like really take something and really blow it up, right? We saw that with the pandemic. We saw that, you know, with the COVID numbers every day being announced and, you know, making us all on edge. And now we don't really hear about that as much anymore. I think it's important to really focus in on making sure that you're investing in the right positions, that you're setting your portfolio up for the next, you know, few years as we work through the inflation, making sure that you're defensive with your portfolio and, you know, making sure that, you know, that you're positioning yourself in the right way. So whether or not you feel like you can handle it yourself and you feel confident in your abilities, or you want to work with, you know, a financial planner at the bank branch who would be able to offer you to buy, you know, the bank's mutual funds. So whether you're with TD or BMO or RBC, they're all very similar when it comes to the products that they offer. So that's one place that you could go. You know, another place, like most of the banks have brokerages. So whether it's RBC Dominion Securities or BMO Nesbitt Burns or BMO Private Wealth, pardon me, CIBC, Wood Gundy, the TD Private Council, I think is what it's called. So those are all people that, you know, would be basically be able to provide you sort of a higher level of advice and wealth planning advice that they should be able to build out a well-diversified portfolio for you, you know, based on your specific needs and investment objectives and your risk tolerance. You know, I guess one of the questions that's coming out is, should you be investing in an investment company if it's a private investment company, or, you know, have someone like that's working in a bank as well? I mean, as long as the private investment company has a very good reputation, I think it's important to make sure, like, be asking the right questions, like who's their custodian, because most private investment companies would need a custodian, which is usually a Canadian bank. So asking, kind of the right questions to make sure that there wouldn't be any scandals or, anything like that. So, where can we find advisors with a fiduciary duty to their clients? I mean, it's a great question. I'm not sure that there's like a database somewhere, but I know like I have my portfolio management license, which is that I have a fiduciary duty to my clients. And I think there's a very small percentage of advisors that actually have that license, because there's many requirements in order to, gain that license and have that fiduciary duty. I think on the chartered CSC, so the Canadian Securities Institute, has anyone who's listed on there that has their CIM or their CFA. So the CIM, which is the designation that I have, is a chartered investment manager. The CFA is obviously a chartered financial analyst. Those two would basically, coupled with years of experience, assets under management, case studies, all that kind of supervision, all that stuff, would then let you to get the discretionary fiduciary duty to your clients. So I think that Canadian Securities Institute lists all of the people who have that license. I think it's public. I'm not 100% sure. But I think that would be maybe a good place to start, or asking for recommendations from your friends or family members, for people, who are they working with, and then asking, that person, or in the interview process, do you have a fiduciary duty to your clients? I think personally, it's really important to work with someone who has a fiduciary duty, because it means that they put their clients first, and it's a legal requirement. It's not just like, oh, I put my clients first. No, it's a legal requirement. So it's just really important to work with someone that would be able to provide that to you. So I know we're getting close to our end here, so I'll just talk about some of the resources that are going to be available to you. I just thought it'd be easier for you guys to have it all back. So wealth planning, facts and figures for 2022, it just gives you some really interesting information for financial planning. A fillable expense summary. So you can put your budget in. A checklist, 10 years plus retirement. So what to be doing if you're 10 years plus to retirement. Some financial resolutions for 2022, which I thought were interesting. There's also a Survey Monkey link if you would like to fill that out for me, and you would like for me to send you any additional information, or you want to talk, or email me or whatever. I'm also on LinkedIn. I'm happy to have conversations offline. I know that there's still a lot of questions I probably didn't get to, just because of the way that the chat has been running as I've been presenting. I think one of the questions was, what designation would a fiduciary duty have? So there's two, and it's the CIM, which is the Chartered Investment Manager. So that's the one that I have. And then there's the second one, which is the CFA, the Chartered Financial Analyst. So those are the two. There's no other ones. So hopefully that makes that very clear. Since interest rates are going up, why aren't we seeing higher interest rates for our savings accounts? So I think I touched upon that. Most of the banks probably will not offer higher savings rates in your savings accounts, but like a Tangerine would, which is an online bank. And would it be a good idea now to be investing in your RRSP now that it's down double digits probably for this year? The answer is yes. If you've got some cash available, it would be good to be averaging in right now. But don't be surprised if the markets go down a little bit more from where we're at right now. So if you had $10,000, maybe I would buy 5,000, maybe I would, buy $5,000 worth of the investments that are in your account right now and keep the other 5,000 for when maybe a month from now or 2 months from now, for when things maybe shake out a bit more. And then, we've seen a little bit more data. Then, that way maybe it's more of a balanced approach, but you could do it all right now if you have a really long time horizon, because the markets, again, even though they're down double digits right now, they could go down further. But just from a historical perspective, they will go back up again eventually. I just don't know when. If I knew that and I had a crystal ball, then, maybe I wouldn't be doing what I'm doing. But it's a very interesting time to be investing. The sustainable funds, there's information out there about sustainable investing. It's all based on companies based on an index called the MSCI Sustainable Index. So all of those companies in that index are considered sustainable, that they have sustainable practices. And then you can see how they're ranked, and it's from 1 to 5. And if they have a 5, then they're considered the highest on their sustainability ranking. A 1 would be sort of the lowest. So you can skim through those companies and see, which ones have a 5, and then by industry to see where you're most comfortable, because some clients don't want to invest in, energy because of that sustainability piece, but a lot of energy companies are actually quite sustainable. So it's a bit of a misnomer. So I would start with, Googling the Sustainable Investing Index, and you can see how the companies are ranked from 1 to 5, and you can see that which companies have the highest sustainability rankings, and hopefully that helps. There are sustainable mutual funds, like they have that are focused on sustainable investing, like companies that have sustainable practices and that are sustainable. There's exchange traded funds. You can also just buy the index of sustainable investments, the MSCI Sustainability Index. You can buy that. It's available for purchase online too. I'm trying to think about anything else. And I think that pretty much covers that. So hopefully that answered that question. And yes, there will be a link to the recording session. And then in the chat box, the survey link was also sent out to you. So if you would like to fill that out, then please go ahead and fill that out. And if you have any questions for me directly, please feel free to email me or give me a call, or I'm on LinkedIn, Keeley Simpson. So hopefully that, has helped answer most of the questions today. And hopefully I guided you through the sort of the basics of investing and financial planning. So thank you all for attending today's session. I appreciate your time, and I hope that you got a couple of aha moments, and I'm happy to, chat further offline if you would like. So I wish everybody a great day. And again, thank you for joining. And, things will get better from here. They just will take time. So thank you very much.